If you know anything about the market, you should know that the market has both losses and gains. What you might not know is that losses can have more of an impact than gains on the value of your portfolio. Consider this purely hypothetical example. Let's imagine that you have a portfolio of $100,000, but then you have a 25% gain. That's $25,000. So the value of your portfolio after 1 year is $125,000. Now, let's say the next year the market's down. Let's say it's only down 20%. Well, what's 20% of $125,000? It is $25,000. So now you're back to $100,000. You were up 25%, and then your portfolio experienced a 20% loss. You weren't down 25%, just 20%. But mathematically, it turns out that even though your down year was not as big as your up year, you ended up back to even. In fact, you could say that your average, a 25% gain minus a 20% loss, equals a 5% divided by the 2 years. You average a plus 2.5% return, right? You actually averaged a positive rate of return. But how much did you earn? Nothing. You had a 0% actual rate of return. That's because when it comes to investments, losses can have more of a significant impact on the ending result than investment gains. If you experience a loss, in this case 20%, you need a 25% gain just to get back to even. It doesn't matter in what order the gains and the losses occur. A bigger gain is always needed to offset a smaller loss.